There everyone, hope you're all well. Welcome back to the YouTube channel. So this video here is going to be on how to trade key levels, so how to identify them and then possibly take positions from the best levels within the market. As always, I'm going to make it as simple as possible so that by the end of this video, obviously you're in a good position to analyze the market yourself and then maybe profit from these levels, okay? So originally, let's just start with what is a key level. So when we are looking at the charts and analysing them, a key level will refer to an area within the market where price has struggled to, in the past, break through. So usually it's on numerous occasions. So we're going to go over examples showing you kind of like how they are and how to see them. But there's a couple of reasons why it could happen. It could be a psychological number or a level. And then also a lot of buying and selling pressure in and around the same level. So there's multiple reasons why a level may continue to work. We don't necessarily need to understand why the level is working. We just need to obviously be able to identify it and then potentially take trades from them. So following this, key levels can be used as confluence. So I will personally rarely take a trade just from a key level on its own. I will require other confluences to line up with this before taking a position. But overall, a key level is basically included in every single trade that I will take. This means if an area doesn't have a key level and there's just some other confluences, I most likely will not take the position and I will actually wait until something lines up with a key level before obviously taking it. Why do we use a key level is next. Main reason is support and resistance. So key levels will usually act as support and resistance when price is coming to them. This is usually just because as traders, we will make decisions based off the areas. It could be you're entering a position, you're exiting a position. All it is that if you're entering or exiting a trade, you can see where the market currently is. Is it approaching any areas where price may react? And then based off that, we will obviously make decisions and money will then be coming in and out of the market to potentially make it work. Following on from this, you've got the market psychology. So basically following on from what I just said in terms of a lot of traders in the market, they will basically identify areas that they think is going to work. Following this, they will basically be able to, either enter a position, exit a position, and because of that, a lot of people may potentially be looking at the same levels and therefore obviously a reaction could be given. So as always, it's just a case of the market likes to repeat itself. So if there's areas that have continuously worked, then obviously there's a good chance it's going to work again. And then following on from what I said in the last slide, it's all about confluence. So regardless of any way someone tries to explain this, using a key level just means it's building confluence in and around an area. There's no special way or thing behind it. It is simply due to the fact that when we are using key levels, it is just a reason to enter a trade. Due to that reason, obviously, that is why it's a confluence. It's a reason to enter the position. So that's all it comes down to. Use a key level as a confluence and not as the be-all and end-all. So now let's look at types of key levels. So there's two that I would like to go over in this example. The first one will be support and resistance, which you might be familiar with. This is basically just areas within the market where price has acted as support or resistance, or the floor or the roof, depending on, obviously, how you like to visualize it. So I've previously said this as well. The market likes to repeat itself. So if price has bounced multiple times from a certain area, there is a high chance that it will happen again. I know some people go into all the liquidity side of things and stuff like that, but at the end of the day, the market repeats itself. You can see it over and over every single day. So yeah, support and resistance levels do usually make for a good trade. And then the other one, which I know some people do use, but most people don't, is finding wicks within the market. So by finding a wick, you have identified a large reaction in the past. Due to this large reaction, that would mean that a big sum of money has come into the market, whether it's obviously selling or buying. A big wick means that there was a big reaction. Following on from what we've said with the market repeating itself, a big reaction could happen again, and you're going to see some examples of where this has happened, okay? So basically by identifying these key levels, and whether it's the support, resistance, the wicks, whatever it may be, we may anticipate what is going to happen in the future. So first of all, let's look at a support and resistance area. This here is pretty simple. You can see on the left hand side we have got support. On the right here we've got resistance, and then price broke this area, retested it as support. So for that reason, this area has worked multiple times. You could look to potentially build confluence in and around this area once you see the break, to maybe try get into the retest of this area, and then as you can see, price has continued to rally up. So this here is a pretty straightforward example. The only downside to support and resistance areas is that there is sometimes a lot of drawdown either side of the level. You can see here we had a wick breakthrough, wick breakthrough, wick breakthrough. Same again here, wicks through. So although the candle bodies and where price closes is in and around the area, when we're looking to enter a position, following this you may expect some drawdown. This is why I personally like wicks. By looking at the wicks, you are looking at a more accurate area within the market. Obviously you can see on the left hand side there was a big reaction here, a big reaction here, then a little liquidity sweep back into the market to trade, and then look what happened once price came back to return. Hit this area here and gave a nice reaction. So these two reactions here which happened, although they got retested after, that doesn't invalidate them, okay? So by looking at these two big reactions within the market, we are identifying that there has been big reactions here in the past. Price has come back to it in the future and worked. If you had confluence in and around this area to take a trade, you would have obviously profited. And you can see how accurate that is compared to this example here, where yes, we got a nice reaction here, but obviously either side we did get drawdown on previous occasions, okay? So what I will do now, I'm just going to go onto the chart and identify how you can potentially look at some positions, and then yeah, you should hopefully understand the ins and outs of different types of key levels. Currently we are looking at the gold chart, so we know that gold historically does like previous price action and also structure. So structurally, gold should be a good bet when it comes to obviously taking positions. Now, when we are obviously looking at gold now, we basically want to identify areas where price has potentially respected multiple times, okay? So by looking at this example here and looking where price currently is, we can basically identify lows and highs within the market and see what's what. So we've got a low here, a low there. This now then becomes structure here. And if we go further left, you can see you've got that. So this area here is obviously support, support, resistance, 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 support. We had a bit of a liquidity spike and then we're back in, okay? Some other areas you may want to look at is obviously these highs up here, but that's not what we're going to go over for this example. If we then look into this position here, you can start looking to build confluence in and around obviously an area. You could draw your trend lines, you could draw obviously your Fibonacci's like so, and you could basically look at this area and make a decision based on what you want to do. In this area here, you can see we've got the key level. There's a 78 Fibonacci down there, so let's put the zone down there. So then in this area here, you've got a nice key level of support and resistance. You've got a 78 Fibonacci, you've got the 1910 round number, and potentially a trend line touch, depending on where it hits. So what you could do, set your position, stop loss below the level. Obviously, if you want to look here where price has spiked through, you can see every time price hit this level bar the liquidity spike, that price didn't come through the level. So in this situation, you could look to put your stop loss here below these, or if you want to be super safe, put it below that low there, okay? For the example, we'll keep it safe and put it here. Obviously, TP1, you can do the high if you want for a 1.8 risk to reward. And then let's have a look what happens. Price comes down to the area, taps that area, and then there you go. Price continued, and I think, yep, continued up. And then obviously if you wanted, you could target these types of areas, the highs, when it come to the position, okay? And there you go, hit. So overall there, you would have maybe got like a 4.5 or something like that. But that just basically shows the example of a structural position. If we obviously look at this, let's break it down one last time. Support, support, resistance, resistance, support, liquidity sweep, breakout, retest the area, and then go again. So all this means is that buyers came in the market, buyers came in the market, sellers came into the market, buyers. Here, obviously, out, grab some liquidity, and then back in. And then here, buyers have come into the market again. That's as simple as it needs to be. Find an area where there's been multiple touches in the past, and then following that, you can obviously look to make some money based off that position. Something like this, if we look here in general, you can see that the market, although it's a big area, like with that, you can see multiple times price touched this area. What happens once it was broken? It got retested and then price pushed down, okay? So you are simply just finding the major structure points within the market that have acted as support or resistance, trading them, and then obviously targeting further structure in the future. So that is an example of support and resistance. Let's now go over to my favorite, which will be Wicks. Same again now, we are looking at gold, but instead of looking at structure, we are going to look for the wicks. Now, a lot of the time, the wicks will involve support and resistance, but obviously, instead of just looking at areas where there's been bounces, we are actually going to start looking for areas where there has been big reactions, okay? So if we look at this market now, let's find some areas where there's been multiple wick reactions. There's here at the bottom. If I duplicate that, there's here as well. If I do that, and then as well, if we look up here, there is a nice two big reactions there, okay? So these would be areas within the market that I might be interested in when I'm looking at gold, okay? What do we notice about the market? Well, we've had a nice break of this structure point here. We've got two big wicks, meaning two big reactions. What does that mean for us? We can anticipate that when price comes back to this level, we are going to get a similar reaction, but on the other side. Easy as that, okay? So let's just analyze and see what happens with the market. Price pulls back. In this situation here, if you really want, you could draw, you know, a Fibonacci. You could, like, again, once again, start drawing trend lines. Whatever confluences you use within the market, you can start to do. By looking at this example here, in and around this area, we have the key level break retest and also the 50 Fibonacci. So I might draw an area like so to say this is where my confluences lie. As always, you can put a buy stop here, target the next liquidity point if you'd like, and then stop loss wise, completely up to you. You can put it below this little bit of structure there on the lower time frames. You can put it below the trend line, put it below the fib, whatever you want to do. You can do it, okay? Let's just say we want a 3-to-1, meaning this. Let's then play it out. And like in this situation here, we'd have to up this now. As you can see, price has tapped into this area and given a reaction. So I didn't even really mean to show that example. That's just actually happened. So by having these two big reactions here, price came into the zone. There may have been a Fibonacci there. Let me just quickly look from here. As you can see, there was a 61 Fibonacci. So what we're looking for on the way up, there was also it on the way down. So 61 Fibonacci, key level into there. We now have a Fibonacci from here, obviously with here, 50 Fib, key level, etc. Let's see what happens. Price comes down, perfect third touch of the trend line pretty much. And then what does price do? Heads to that high. So just by looking at this example here, how can we build confluence? So price has pushed away from this area here, which is absolutely fine. We've seen price break to the upside and break the bearish structure. So we could potentially now expect a bullish structure change. We have the third touch of a trend line, the 50 Fibonacci, a key level, and this is everything that I have gone over in the previous YouTube video. So if you do want to understand trend lines better, then watch the previous video. I'll put the link to it in the bio, and then that should help you, okay? So just by looking at this example here, you've got a nice 3-to-1 risk to reward, third touch of a trend line, 50 Fib, key level, everything's lining up perfect, and that is how we would use the key level using the wicks. So in this video, we've gone over the wicks, we've gone over the support and resistance, and we've gone over key levels and what are they and how you can use them. So if you have learned something from this video, guys, please leave a like. Obviously, the links to the group are in the bio if you are interested. And then, yeah, I'll see you in the next video, probably next Thursday evening.